All right, in our last section in Chapter 8, 8.8, we're going to talk about credit cards. Awesome and dangerous all at the same time. Your book gives us a little statistic where it says that in 2016, the average credit card debt per U.S. household was $16,748, where people were paying almost $1,300 in interest each year just by having a balance on their credit card. $1,300 in just interest. You're giving that away to Visa or Discover Card. That's a lot of money, right? Now we're going to talk about credit cards in this section, where credit cards are an example of an open-ended installment loan, commonly called revolving credit. Customers receive a statement called an itemized billing that includes the unpaid balance on the first day of the billing period, the total balance owed on the last day of the billing period, a list of purchases and cash advances made during the billing period, and any finance charges or other fees accrued. Customers who make a purchase during the billing period and pay the entire amount of the purchase by the payment due date are not charged interest. So if you use a credit card, you could actually build up really good credit by using a credit card and paying it off in full every single month. Unfortunately, where people get in trouble is that they don't pay it off in full and they keep adding to that balance and they just end up paying the minimum payment, which means you're paying a lot of money in interest and never really paying down your balance. Now, interest on a credit card is calculated on what we call the average daily balance method, where we've seen that interest can be calculated using the PRT formula, right? In this case, R is representing the monthly interest rate as a decimal, T is 1 month, and then P is based on an average daily balance. The average daily balance is when you add up all of the unpaid balances for each day in the billing period and divide by the number of days in that billing period. So you're adding up all the balances and dividing by 30 or 31 or however many days are in that billing period. So that average daily balance might be higher than what your actual balance is, might be lower than what your actual balance is, but it's an average. So they kind of balance it out and then calculate your interest on that amount. So we're going to do an example here. Example number 1 gives us some information. It says a particular Visa card calculates interest using the average daily balance method. The monthly interest rate is 1.3% of the average daily balance. The following transactions occurred during May 1st through May 31st billing period. So if you look at the chart really carefully, it says that there was a previous balance on that credit card of $1,350 was the balance that came from the month before, right? And so you can see all the different payments and purchases that were done through the month of May on this itemized billing sheet, right? And so it's going to ask us a few questions. Number 1, find the average daily balance. Number 2, find the interest on that average daily balance. Find your balance due on June 1st, so after you make all these purchases and there's finance charges added, what's your new balance going to be? And then let's talk about what the minimum monthly payment would be. So if we go back to the information, the first thing they ask us to find is an average daily balance. What that means is we've got to add up the balance every single day in May and divide it by 31, the number of days in May. So let's go to this itemized billing and figure out what the balance is on day 1, day 2, day 3, day 4, all the way to day 31. Add them together and divide by 31. Now, you can do that for every single day 31 times, or we can look to see what the balance is on May 1st. Remember that there was a beginning balance of this $1,350, and that balance stayed $1,350 until it looks like May 8th where they made a payment, right? So the balance starting on May 1st was $1,350, and it happened to be on May 1st, 2nd, 3rd, 4th, 5th, 6th, 7th, and then it changed on the 8th. That's 7 days that they had a balance of $1,350. So you can take $1,350 plus $1,350 plus $1,350 for the first 7 days. Or couldn't you just take $1,350 and multiply it by 7? And that would give us so far a total of $9,450. Now, that's not how much you owe to your credit card. Remember, you still only owe the $1,350. But what we're doing is we're using this total to find an average. You know how to find an average, right? Add them all up and divide by however many there are. So that's what we're doing. All right, but it looks like on May 8th we made a payment. We made a payment of, $250. So that means our balance actually went down. It was at $1,350. If I subtract my payment of $200, my balance now is $1,100. And my balance was $1,100 on May 8th, May 9th, but it changed on May 10th because then I made a purchase and bought airline tickets, right? So the balance was $1,100 for May 8th and May 9th for 2 days. So I can take that $1,100 and multiply it by 2. So far I have $2,200. On May 10th, I bought airline tickets. That means my balance of $1,100 went up because I just added $375 to my credit card. If I take $1,100 and add the $375, my new balance now is $1,475. I had that balance on May 10th, 11th, 12th, 13th, 14th, 15th, 16th, 17th, 18th, and 19th, and then it changed on May 20th. So how many days did I have a balance of $1,475? Looks like that's for 10 days. So 1475 times 10, and I'm going to keep adding this to my running total, right? All right, it looks like on May 20th, I ended up buying books. I added more to my balance. My balance was $1475, but I just added another $57.50 to my credit card. My balance now is $1,532.80. And I had that balance starting on May 20th, and I went all the way to May 27th, right? If you add it up, even use your fingers if you need to, that's 8 days, right? 8 days of that balance. When I multiply 8 times the 1532, I end up getting $12,260. My balance changed though. On May 28th, I went to a restaurant and I charged to $65.30. So I need to add that to my balance again. And let's calculate how long I had that balance for. That was on May 28th, May 29th, May 30th, and May 31st. That's 4 days of that balance. So I'm going to multiply it by 4, and I end up getting $63.91.20. Now remember, this isn't what you owe to your credit card. This is just adding up the balances every single day. So if I continue to add up all of these balances, I end up getting a total of $45,051.20. These are all the days added together. We don't owe $45,000 on the credit card. Remember, we only owe $1,597.80 at the end of the month. But the $45,000 is adding up the balance every single day so we can find our average daily balance. So in part A, it asks us to find that average daily balance. I added up the whole balances for every single day. That was my $45,000. And I'm going to divide it by however many days there are in this billing period. And from May 1st to May 31st, there are 31 days. So I'm going to take that total and I'm going to divide it by 31 days. That'll give me my average daily balance. So it looks like my average daily balance is $1,453.26. That wasn't my balance every single day. Sometimes it was higher, sometimes it was lower, but that was my average daily balance. This is the amount your credit card uses to figure out how much they're going to charge you in interest. Remember, we're going to use that PRT formula to figure out our interest. Remember, our P is our average daily balance that we just found. R is the monthly interest rate, and T is for the 1 month. So we're going to plug in our information. We have our average daily balance that we found in Part A. Remember, our monthly interest rate was 1.3%. So as a decimal, we're going to plug in 0.013. And we're going to be charged that interest for the 1 month of May, right? Multiplying all those together, I ended up getting $18.89 in interest. So in addition to the amount that you owe to your credit card, they're going to charge you another $18.89 in interest. So the new balance on June 1st will be the balance that you owed at the end of May. Remember, the balance that we owed at the end of May was the $1,597.80, plus the interest that they're going to charge us, the $18.89, for a total of $1,616.69. That will be our balance due when it comes due. A lot of times there's a little bit of a grace period, but the balance on June 1st that'll be due is that $1,616.69. Now, Part D says this credit card requires a $10 minimum monthly payment if the balance due at the end of the billing period is less than $360. Otherwise, the minimum monthly payment is 1/36th of the balance due at the end of the billing period, rounding up to the nearest whole dollar. What is the minimum monthly payment due by June 9th? So again, you have that grace period. It looks like this one is 8 or 9 days. You have to have your minimum payment due by then, or they charge you additional fees for being late. And a lot of times then your interest even goes up from then on, and now you're paying more interest every single month until the end of you having that credit card. So you've got to be careful and make sure that you're on time. So if our balance due was that $1,616.69, we can take it and figure out our minimum monthly payment by taking 1/36th of it, or dividing it by 36. So $1,616.69 divided by 36, if we round it to the nearest whole dollar, would be a minimum payment of $45. I will send in that $45 if I'm just making the minimum payment and only barely pay off my balance. I'm then going to be charged interest the next month. I might even accrue some purchases. So you can see how credit card debt can add up very quickly if you're not careful.